Welcome, Joshua and Hazel Brown. Hope you're having a great day. My name is Drashti Shah, and thank you for coming in to meet with us today. We appreciate you choosing us on your financial planning journey. And without any further ado, let's begin. So this is our meeting agenda. So we are going to first off start with a little introduction, followed by looking into your current situation, which is your current portfolio. We are going to then recommend purchasing new asset classes and replacing the old asset classes that you currently have. Then we are going to explain you about your loss bearing capacity, that is of your portfolio, and then we are going to show you your new rebalanced portfolio, and then we are going to briefly educate you on the funds, the ones that we are recommended and why we are recommending those funds. And then we are going to wrap up with any questions that you have for us. So let's begin. So let's begin with reviewing your current situation.
Hello, Joshua and Hazel Brown. During the discovery meeting, you two indicated that you'd like us to look at your current portfolio. Then here's your portfolio as it stands today. As you can see, it's heavily weighted in money market and international bonds. A little bit of Canadian equity, not much in the fixed income and US equity value. Okay, so before we recommend any changes, let's look at your investor profile and what we filled out when did the questionnaire with you. If you recall, the investor profile had questions such as primary purpose of your portfolio, type of portfolio would like to own, how long are you willing to wait for your investment to regain its value, the time horizon before you start withdrawing a significant portion of your portfolio. Based on that questionnaire, we had found the following: that both of you are not uncomfortable with risk. You recognize that to achieve a balance between finding undervalued assets and identifying companies with strong growth potential, you understand the importance of diversification to manage risk. You often build portfolios that include a mix of growth potential and reasonable valuation. And you too stay informed about market trends, economic indicators, and emerging technologies. Both of you are open to learning and evolving your strategies based on new information. Given the results of our investor profile discussion, we have determined that you two are balanced growth investors. And with that in mind, we would like to recommend the following changes to your current portfolio. Then my colleague Drashti is going to present a recommended portfolio for you too. Drashti?
So now we are going to look at the recommended portfolio. In our recommendation, we recommend the following changes to your asset mix. Through research on these investments, we recommend that you sell out your entire portfolio. However, it is not a bad investment. Though after the research and effort we put in to design the new recommended investments, we strongly believe that it will be more suitable to your investor profile. So after selling your current portfolio, your new portfolio will look as follow. We would recommend that you invest $10,000 each in Horizon Active ETF Common Bond and Horizon Universe ETF Bond. And replace the $25,000 of Council Canadian with Purpose Equity, allowing a good mix and diversification to your Canadian bonds. Furthermore, we will be implying the same concept to your U.S. and international opportunities, such as investing $25,000 in IA Clarington US equity and $20,000 in Invesco EQV International Equity, and $5,000 each in iShares MSCI Emerging Markets and MSCI Min Emerging Markets, and this will round us out, giving us a nice portfolio, as you can see. Furthermore, moving on to new asset allocation and holdings, we now have a well-diversified portfolio as follows, where 20% is in fixed income, 25% is in Canadian equity, 25% is in US equity, and 20% is in foreign developed equities, and the remaining 10% is in emerging market equities, which is market for a balanced growth investor. such as yourself. Now you might notice that the HSBC Canadian Money Market Investor account, you might have noticed that a balance of $0. However, that's fine. What we have noticed with your current portfolio is that it seems highly unlikely that you will require immediate access to cash. However, this might not necessarily be the case in few years from now, as you have indicated that you are considering sending your son David to a special private school as he has learning disability, and you are not sure about his long-term career prospects. It's likely that you might require access to cash then, and hence setting some cash aside now will be recommended. Furthermore, if you need to put money in, we will recommend that the HSBC Canadian Money Market for a few assets.
As in the previous slide, my colleagues explained to you about the new asset allocation model and the funds that we suggest that you purchase. We also need and we are obliged to tell you about the market. Sometimes the markets may be up and sometimes the markets may be down. So it is up to you and your risk bearing capacity that how much and how willing are you to go down if the market goes down. In this slide, we can see that if the market is going down and all of your investments are going down by say 10%, so the 100,000 that you have initially invested will have a new valuation of $90,200. So in this capacity, anyone will panic and we have to sell. But in this scenario, you have to stay calm and believe and trust in me that your investments are in good hands. So if you don't panic and we don't sell your investments, it is for the longer run and we have to keep going and going and going. Adding to the previous slide, we would like to rebalance your portfolio according to the new valuation that it has of $90,200. This means we will allocate the funds that we previously decided, that 10% to the fixed income and everything rest be the same. We will reinvest all those funds and rebalance it so that each and every fund has equal valuation that we have decided. And this will also give us an opportunity to add more money if required, so that we buy at cheap and we will sell at high. So this will be an interesting part where you as an investor will look at it and say that okay, fine, we can risk this much money and we can go down to this.
Hello Joshua and Hazel, I have got some investment options that could be a great fit for you. So let's go through them one by one. First up, we have the Horizons Active Canadian Bond ETF. This is all about investing in Canadian bonds, which are like loans from the government and companies. The cool thing here is that the experts manage it actively. They watch the market closely and choose the best bonds to invest in, which can help us make good choices even when things change. So if you are thinking of having around 10% of your portfolio in bonds to balance out the risk, this could be a solid choice. The company managing this fund is Horizons ETFs Management. They have been around for a while and are all about making investing simple and smart. Next is the Horizons CDN Select Universe Bond ETF. This one is also about Canadian bonds, but it takes a different approach. Instead of actively choosing bonds, it follows a specific index. Think of it like following a set of rules. When the index changes, the fund changes too. This can be a bit simpler and usually comes with lower fees. So if you're looking for something straightforward and cost effective, this could be a good fit. And yes, it's also managed by Horizons ETFs Management, the same company we talked about earlier. Moving on to the Purpose Core Equity Income Fund. This one is all about Canadian company stocks. The goal here is to get you some growth in your investment and also regular income. The way they do this is by picking companies that have a history of giving out dividends, that's like a share of the company's profits, and that are expected to grow well. So if you're someone who wants both your investment to grow over time and a steady income along the way, this fund could be a great match. The person managing this fund is Greg Bessinger, and he really knows his stuff when it comes to investing. Next, we have the IEA Clarington US Equity Fund. This is all about investing in big US companies. The US market is known for its potential for growth, and this fund aims to capture that. So, if you are excited about the idea of your investment growing over time, especially in the dynamic US market, this could be a strong contender. The fund is managed by a team of three experts from QV Investors. They have got a lot of experience and know their way around the market. Remember, before making any decisions, we should have a chat to make sure these options match your overall plan and goals. I hope this breakdown helps you understand this investment choices better. Feel free to ask any questions or let me know if you want to dive deeper into any of these options.
As mentioned in the previous slide by my colleague, another great fund that I would be recommending would be Invesco International EQV Equity Fund. This fund mainly focuses on diversifying your portfolio by investing in great growth potential companies outside of North America. Now, given your risk tolerance and your investment goals, we believe that this fund is a valuable addition to your portfolio. If well managed, the opportunity for growth that complements is great. Now, for the team that is overseeing this fund is a seasoned professionals. Each of them have an experience of more than 10 to 15 years in the industry. They have proven themselves through their long track records in investment and analysis. Mainly the CEO Steve, along with the head of the department Mark, they both oversee the fund. Another great fund that I would recommend investing is iShares Core MSCI Emergency Markets IMI ETF. It's a mouthful, but it's simple. This ETF tracks the MSCI Emerging Markets Investable Marketing Index, giving you an exposure to a wide range of emerging market equities. Now, emerging market equities offer high growth potential, so this ETF lets you tap into their growth. From your portfolio, allocating just 5% to this foreign emerging equities through this ETF could open doors to growth in many promising economies. Now, this fund is managed by BlackRock Asset Management Canada. Now, BlackRock is an investment leader in the current market. Another great fund that I would recommend investing is iShares MSCI Minimum Volatility Emerging Markets ETF. Let me break down. This ETF is all about a smart approach to emerging markets. It focuses on companies in emerging markets that have lower volatility. In simpler terms, it's a defensive move in high risk space. This could be a great fit if you're looking to manage risk while still tapping into potential growth. Now, just allocating 5% of your portfolio to this ETF, it's a strategy that will let you benefit from emerging markets growth while still staying on a cautious side. Apart from this, if you have any queries for me and my team, you can please ask them now, Mr. Brown.